Good morning and welcome to this Monday, May 16th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we're getting off to another week here. We're going to start the second half of this calendar quarter. Done some studies. And typically, this isn't very good news given the state of the market, but normally the second half of a calendar quarter performs worse than the first half. So when I'm talking about these different halves, like for the first quarter, January 1st to March 31st, I'm talking about the first half of that quarter being January 1st to February 15th, second half of the quarter being February 16th to March 31st. Same thing, the current quarter we're in, Q2. You've got April 1st to May 15th, which just ended. That tends to be the more bullish half of this quarter. And then you've got the 16th to the 31st, or 16th of May through the 30th of June, the second half, which tends to be not as good. And I think a lot of that just is money flow as you run into earnings season. Earnings season, of course, starts in the first half of that first month. So normally around January 15th, April 15th. Earnings kick in, you've got the pre-earnings run up at the beginning of that period. Then you actually have the earnings coming in. And then by the time earnings slows down, you're beyond the news. And at that point, many times you'll see the sell-off. So I guess, first of all, that's bad news. But then on the other hand, we didn't get that run up in this first half. So not sure what that means. I've never done this study to see what happens when we have bad first halves of the quarter, but I got to believe that the second half on a relative basis probably does a little bit better. Anyway, just thought I'd throw that out there for those of you interested in that sort of thing. I do follow history a lot, so I always find it interesting to see how the market performs during certain periods of the week, during the month, during the quarter, year, whatever, the various performances by month. I track all of that historically, and I've done so since 1950. I've got a spreadsheet that shows the S&P 500 every single day since 1950. So we do a lot of historical analysis. In fact, there's going to be an event coming up fairly soon. I think it's next week, it might be the week after, but I think it's next week. That'll be taking a look at some of the historical tendencies. So if that's something that you're interested in, that will be a members only event, but we do have 30-day free trial. And one thing I definitely want to mention before we get going here is that we are starting our spring special today. This is the best deal we have all year at Earnings Beats. So if you enjoy, our guidance, our research, the education we provide, now is the best time to check out our service. Let me go ahead and pull up our homepage here, earningsbeats.com. Make sure you check that out. Right here, you will see the best deal. You can buy 1 year, you get 2 months free. You buy 2 years, you get 6 months free. And if you buy 3 years, you get a full year free. So 4 years for the price of 3. This goes through Monday, May 30th. So you got, excuse me, you've got 2 weeks to check this out. So like I said, come in now, you get a 30-day free trial. You will have to give credit card, but you get a 30-day free trial. And at the end of the 30 days, this is when this would kick in. So if you decided in a week that, hey, this sounds like a good deal, you pick however long you want to go out, and that will be tacked on to the end of your 30-day trial. It's not like you lose the rest of your 30-day trial. You still get that. So anyway, now is a great time. All you do is go in here and click on this on our homepage, and it'll give you a little bit more give you an opportunity to sign up and a little bit more information on the deals. All right, let's go back over here now. And for those of you who would just like to learn more about us, one way, probably the easiest way, is just to sign up for our Earnings Beats Digest newsletter. Had an interesting article. I always like to write articles about predictions and forecasts and so forth. And so I did one this morning on the S&P 500, went back, hit the rewind button, went back to the January 8th Market Vision event, talked about where I saw the S&P 500 going in the first half of 2022. And it was remarkably accurate. Of course, we're not quite through the first half. We still have the rest of May and then, of course, June. But I had the S&P 500 going down somewhere in the 35 to 3,800 range in the first 6 months of this year. And that was from 4,800 at the beginning of the year. I don't know that too many folks had that kind of forecast at the time because we were sitting at an all-time high. But that's what I saw, and the market has been following it almost to a T to the downside. I'll show you a chart on that in just a minute. But anyhow, if you want to just check out what we do, this is a great way to learn more about earnings beats. Just sign up with your name, email address. This one requires no credit card. So you can sign up. It's completely free, no credit card. You can unsubscribe at any time. Comes out 3 times a week, Mondays, Wednesdays, Fridays. We do this just to give back to the community, folks that have been supporting us for many, many years. And this is a massive newsletter now. We have a lot of professionals, a lot of individual investors that subscribe to our Earnings Beats Digest. So when we do free events, we reach out to everybody in this community and provide room instructions to come in to the events. That's another benefit in addition to receiving the newsletter 3 times a week. All right, so let's move on here and let's talk a little bit about what happened last week. Friday, we got a nice bounce, and I sent out 2 special reports last week. I think one was on Tuesday and the other was on Friday morning, both detailing how sentiment has gotten to an extreme here of late. Finally, if you recall, and you've been following us for a while, back at the beginning of the year, I thought the biggest issue in the market was sentiment. We had 2 years of running higher and higher and higher on the S&P 500. In fact, I think it was over the course of 390 days or something like that. I can show you in a minute, 391 days. But when you do a rate of change for the last 391 trading days, we were up, I don't know, 115% going into the beginning of this year. If you did a look back over the last 391 days, and that 391 days represents from the pandemic low, the March 2020 low on March 23rd, through the first trading day in January of this year, January 3rd. That was 391 trading days. And I calculated the rate of change, and it was by far the highest ever. By far the highest ever, going back to 1947. I think I went back 75 years. So we had gone up a lot. The market needed to pull back, and the sentiment had gotten so bullish. All of the post-pandemic investors that came into the market have seen nothing but going up all the time. Every pullback just means buy, buy, buy. I mean, that's what you do, and you just make money. It's an ATM. Well, the stock market's not an ATM, and 2022 is showing that it also accepts deposits. It doesn't just give you withdrawals. The market taketh away, and that's what we've seen in 2022. Anyhow, Dow Jones, you can see though on Friday was up 466, S&P up 94, NASDAQ 434, mid cap up 61, small cap 28. On a percentage basis, the Dow was the worst, up 1.47%. And then you had all the way up to the NASDAQ, which was up almost 4%, 3.82% on Friday. We haven't had too many up 400 days. We've seen a lot of down 400, 500 days, but not too many up 400. So it was nice to see a little bit of relief in the market. Looking at the sectors, some of the areas that we would want to see at the top were at the top. Discretionary up almost 4%. Then of course, energy. This is kind of weird that discretionary, energy, and technology all went up together. Usually it's one, normally it's been energy up and discretionary and technology down. Occasionally, every once in a while, it'll flip, but rarely have we seen all 3 of these lead. So that was a little strange on Friday. Anyway, energy also up over 3%, 3.4%. Technology up 3.3%. Real estate 2.5%. Real estate's been really beaten down. I think the surge in interest rates had a big impact there, but real estate down over the prior 3 or 4 weeks. I mean, it had been down close to 20%. I mean, it was almost in a bear market by itself over about a 3-week period. but it did rebound on Friday, up 2.5%. Communication services, which has probably been the worst group going back over the last 6 months, maybe even 8 months. It also got a lift up about 2 1/3%. So good day. All 11 sectors were higher on Friday, by the way. So with that really bearish, extreme bearish sentiment, we saw a bounce. And that was kind of the reason for the special reports I sent out to our members last week, was that it just looked like the market was getting to a point where I would have liked to have seen a little bit more volume. I mean, you can see the NASDAQ was definitely picking up last week. S&P a little bit, especially I guess that was on Thursday when we went down and set that new low. Dow, same thing on Thursday. I don't know if we've hit bottom. You know, if you got out the top, I would definitely be back in at least a portion, maybe half at least, of whatever you got out of. I don't know if we go lower or not. I think if we do go lower, I'm going to be buying it. Most of my account I trade, so I'm trying to catch exact bottoms. I am trading a little bit right now with the QLD. And I did have one retirement account that I've decided I'm just going to kind of ease my way into. I've already started building a position in the QQQ in that, which is what I've been suggesting to members who want to just kind of get back in slowly. I find that working your way back into an ETF like the QQQ is a little less emotional than trying to just catch individual stocks at a bottom, because if you're wrong on an individual stock, you could be down another 30 or 40% pretty quickly. I don't feel that way about the QQQ. I think it's going to be a slower drop if it does go down, and it'll give me some opportunity to continue to build. So that's kind of the strategy that I'm going along with here at this point. This is not 2021 or 2020. You know, you just don't buy pullbacks. This is a cyclical bear market, which I've been talking about all year. You don't just buy pullbacks in a cyclical bear market. You exercise patience in a cyclical bear market. Or if you want, you short. I don't like to short unless I feel like it's a secular bear market. Cyclical bear markets don't tend to last as long. And if you get in that mindset of thinking you're just going to keep making money on the short side, I think you're going to find yourself with some pretty big losses at some point, because the market, when it bounces back and it snaps back, it tends to snap back very quickly. So I'm trying to manage risk as a trader, trying to be a successful trader. I think the most important thing is to manage risk. And that is almost impossible in a market where the VIX is up to, into the 30s. It's been in the 30s a lot this year. VIX in the 30s to me means absolutely no way to manage risk. I mean, it's the polar opposite of being able to manage risk. And that's why, from my trading perspective, I tend to be in cash a lot. It's not that you can't make a lot of money either on the short or long side, but if you're wrong, you lose very quickly. And, it's painstakingly slow sometimes building up your trading account. I'm really not a big fan of losing it in a week. So that's just my own personal preference. But I do spend a lot of time researching the market, checking out patterns, looking to see how previous bottoms have formed. If you recall, back in February, we had a anatomy of a cyclical bear market. We had a webinar that talked about cyclical bear markets. That was very timely back in February, just to bring all of I think that was a members only event, but that may have been a free event. But anyway, bringing our community or our group of members up to date on what they should expect in a bear market. And this is exactly what we talked about, these impulsive moves to the downside. And if you can time them, great, but it's not easy. And then, for me, I know the worst time for me emotionally is being short when the market is going up, because I know the market goes up much more than it goes down. So I've kind of got this, I think a lot of folks just think, especially going into this year, before this year, probably thought I was perma bull because I'm bullish most of the time, but the market goes up most of the time. That's why more and more money keeps coming into the market from not just here in the US, but from all over the globe. It's like, the tide coming in, and you're determined that you can swim faster going out against the tide than you can coming in with the tide. You can't. So anyway, don't mean to be preaching, but cyclical bear markets are dangerous. They're dangerous periods. And what I look to do is simply to try to come out on the other side of them with all or most of my capital intact. And if I can have more than what I had going into the bear market, that's even better. But if I can just come back out with most of my capital intact, I've got that much more buying power. And so to me, sometimes cash is the best position to be in a cyclical bear market. Anyway, let's keep moving on. 10-year Treasury yield. So we did have one economic report out this morning. The May Empire State Manufacturing Index came out. The expectation there was for it to be come in at 15. It came in at minus 11.6. So let's get an update on the 10-year Treasury yield. That actually dropped a little bit. For me, the biggest issue in the market, I said, was sentiment. I would probably also put the Fed up there. I mean, the Fed, when the Fed is hawkish, it's hard for the market to go up. And when the Fed is dovish, don't short. I mean, history just tells us when the Fed is very open to doing whatever it needs to do for the stock market, some bears think that that's bad news and that that's horrible because the Fed is printing money and blah, blah, blah. Listen, don't fight the Fed. That's probably one of the biggest lessons I'll always learn on Wall Street. Do not fight the Fed ever. I don't care if you disagree with their policy. Their policy, if they're dovish, is designed to encourage stock prices to go higher. So if you want to argue with it and, put your foot down, feel free, but you're going to be standing in front of a freight train. What we're in right now is the opposite. We got the Fed, which is very hawkish. They're selling off their mortgage securities and their treasuries, and they're selling off, or they're raising rates. They said they're going to raise 12 times, which I think is absolute hogwash. I don't believe they're going to do that. If they have to do it 12 times, then we're not at the bottom on the stock market. I'll be honest. We are not at the bottom. If they're going to be raising rates for the next year, we are not at the bottom. We're not near the bottom. I don't think they're going to be doing that. I think they're going to raise rates maybe a couple more, probably one more time. Let's see how that inflation report, the CPI, comes out next month. We've already gotten one behind us. There are two CPI reports that needed to come out between Fed meetings. We just went through the first ones. Honestly, they weren't great. We did see the annual rate of inflation drop, as I had said it would. It was a pretty simple math calculation to know that it was going to drop. But we got one more reading coming up next month. I'm hoping and expecting that the slowdown in our economy is going to help take care of that surge in demand that we had coming out of the stay-at-home restrictions. And so normally the Fed would be doing whatever it can to soften the blow of a recession. They're not doing that. They can't do that because they'll lose their grip on inflation, trying to fight inflation. So they have to remain vigilant in fighting inflation. And so if you've got an economic recession coming and you've got the Fed hawkish, it's going to be difficult for the market to go up unless the market begins to feel like the recession is going to hold back inflation, going to start to temper inflation. And if that happens and the Fed gives any hints that, hey, we're going to kind of watch to see what happens here, that is going to be a major clue that you're going to want to be back in equities. Because if they start, right now the market is believing, or at least considering, that the Fed's going to raise into 2023. I don't think that's going to happen. I think at some point the Fed will stop. And I think down the road, I wouldn't be surprised in 2023 to see rate cuts instead of rate hikes. But that's just me. That's just my opinion. All right, 10-year Treasury yield, though, you can see right here, 2.92%. So it is down 2 basis points this morning. I think we finally reached maybe a high. I know 325 has kind of seemed like a magnet because that's the 11-year high on the 10-year Treasury yield. So I thought maybe we'd go up and test that. But it seems now with that high at 316, there's that negative divergence, lower PPO, higher yield. I think with all that in play at this point, we're probably going to consolidate. Maybe we drop down to 260. or maybe we just go sideways and allow this 50 to come up from underneath. I'm not sure exactly where we go here, but I think the 10-year Treasury yield probably has peaked in the near term, just based on the technicals. Doesn't mean that we can't go higher. Technicals don't guarantee us anything. I always say I use technicals to manage risk. I don't use technicals to try to give myself some kind of a guarantee. That'll get you in trouble thinking you have a guarantee. All right, S&P 500, just want to give you a quick update here. There was Thursday. Do you know on Thursday, let me look this up. Hold on, because I got it on an Excel spreadsheet. On Thursday, the equity only put call ratio for the day, and now this is, I don't know what the difference is. There's a difference between what the CBOE shows and what stock chart shows. And I'm going to reach out and see if I can figure out what the difference is. I'll reach out to stock chart, see where they get their data from. But when I use the equity only put call ratio at CBOE.com on Thursday, I had a reading of 1.11, which is the highest reading I've seen in a while. But the individual readings that day, I'm going to take you back. I'm going to pull up a 5-day, 10-minute chart. And so here's Thursday, right at, what time was it? 1 o'clock on Thursday. So right here on this move down from 1 to 1. Well, actually it was on this move down from 12:30 to 1. On this move down right here during that half hour, the equity only put call ratio at CBOE was 2.61. I don't remember a half hour reading ever being that high. So that was 2.61. Then from 1 to 1:30, as it continued moving a little bit lower, it was 0.89. Then at 2 o'clock here, it jumped to 1.48. At 2:30, 1.32. And then at 3 o'clock right here, it hit 1.89. I mean, those 5 readings in a row, 261, 0.89, 1.48, 1.32, 1.89. That's a lot of puts being bought. I mean, that is the market. Let me just put this in context for you for a second. Let me show you. Now, this is stock charts, and their readings are lower for some reason. I mean, you can see the equity only last week was only up to about 0.82, and I showed 1.11. So definitely there's a variation, but I think on a relative basis, you can still use what I'm seeing over at stock charts. And like I said, I'll get clarification, try to figure out where these numbers are coming from. But over at stock charts, if you go back over the last 15 years, you can see that since the March 20 bottom, which is when the equity only put call really spiked, even at stock charts, we were showing a 1.3 reading. I'm not sure what the number would have been at CBOE, but 1.3 there. From that point on, we came down, and look at this cluster of equity only put call readings. These are daily readings for probably a year and a half. Many of these readings were down to 0.4. Below that, most of them, or at least half of them, I would say, was below 0.45. Look over the last 15 years and tell me how many readings you see below 0.45. Not many. We lived there for a year and a half. The market was just buying call, call, call. Remember all the Reddit traders, you know, with their meme stocks? I don't hear much about Reddit traders anymore and what they're doing to individual stocks. I don't know, anybody else hearing anything? It's like crickets. I mean, that's what needed to happen in terms of sentiment. The Reddit folks were pure speculators. They weren't looking at any fundamentals. It had nothing to do with any of that. It's like, oh, this person mentioned AMC. That means I should just buy it hand over fist, just keep buying it because it's going to shoot up. GME. Remember all those stocks? Yeah, we don't hear much about that anymore. Bear markets tend to quiet a lot of noise from the bullish side. Anyway, we went from that market to where everybody was buying calls at record levels to, where was I? Oh, and then to the point where I was just reading out these bearish put call readings. I said at the beginning of the year, we needed to reset sentiment. And this is what I meant. If you talk to anybody about the stock market right now, everybody's bearish. Just bring up the conversation to anyone. If you had had that same conversation 4 months ago, 5 months ago, I can promise you it wouldn't have been the same conversation. This is how we reset sentiment. Once everybody feels like the market can't go higher, and think about why the market stops going up. It stops going up because it can't go any higher, because everybody that wants to buy has already bought. You're just simply running out of buyers. Well, the flip side happens on the way down. You get to a point where you run out of sellers. Listen, Wall Street knows that over the last 72 years, the stock market's gone up 54 of them. Wall Street knows that since 1950, nearly 54% of trading days are higher. Nearly 46% are lower. There is an inevitable, undeniable trend that the stock market goes higher over time. That's why bear markets don't last as long as bull markets. Many cyclical bear markets would have already ended by now. And this is actually a pretty long one so far. We've been in this now for 4.5 months. I said earlier in the year, I thought it would be 3 to 6 months. And I could even go out to 9. I mean, September all the way through the summer months tend to be weak. It could go out to September. I don't know. We'll see. I don't believe it's going to go out that far. But we're at 4.5 months. And now everybody feels like the market can't do anything but go down. And options is where you can see it. You know, there are a lot of folks that follow like the AAII, which is just a sentiment reading that talks about investor attitudes and how they feel about the market. Spare me. I don't care what people feel. I want to know what they're doing with their money. The put call ratio tells us what they're doing with their money. They're buying calls. Why? Now, let me clarify for 1 second. You can do bearish things with calls. You can sell calls. And the CBOE only tracks open interest. It doesn't matter whether you opened with a buy or a sell. So if you opened with a contract to sell 10 calls, which is bearish, that's going to be treated the same way at CBOE as buying 10 calls. So we don't really know everything we need to know. However, there are a lot of studies out there that most retail traders especially will mostly just buy calls and buy puts. And a lot of folks that are selling calls also are selling puts. There's different strategies with options. A lot of straddles, so forth. I'm not going to get, this isn't going to be an options class. But anyhow, there's a lot of things that go on with options. And so I've always followed it, just making the assumption that all open interest on calls were bought, all open interest on puts were bought. But you got to know that some of them were also sold. Anyhow, so the sentiment at this point has now turned much more bearish. And so I wrote an article over the weekend. If you haven't had a chance to read it, go back and read it. Listen, you don't have to agree with me. You don't have to agree with anybody that writes over at Stock Charts or writes anywhere or talks. This is a free market. You can say and do whatever it is you feel like doing. And you know what? The net is what's going to drive the market either to the upside or the downside. So it's a great system. Here, it was I think I said 391 days. It was 451 days. Sorry. But there's the rate of change. And this is going back since the March bottom, 2020, to the January 2022 top. That right there was 451 days. So I did this thing over the last 75 years. And I said, well, how does that 451 day period from here to here, how does that compare rate of change to all other periods going back through 1950, which is the period that I've covered? I mean, 2010, coming off the March 29 or 2009 low, that had a similar move to the upside. 1955, I wasn't born then, so I don't remember that one. But that's what we did. Doesn't the market deserve a break? I mean, we can take the look of the glass being half empty and say, oh, you know, we got inflation, we got interest rates, we got the Fed, we got debt, we got the war, I mean, we can take a look at it that way if you want. Or you can just take a look at it at the glass being half full and say, you know what, we're in a bull market and we just had one of the biggest runs, if not the biggest run in the history of the market. And we're going to complain because we've pulled back a little bit. This is a cyclical bear market, in my opinion. I think we're going to run right back out of this. This was one of the things I showed back at the beginning of the year when we did the Market Vision 2022 event. And I know it's 9:30, the market's just open. If you need to run. This is going to be recorded. You can come back, or it is being recorded. So you can come back and listen to the rest of it later if you need to scat. I get it. But when I get going on something, I like to finish my train of thought here. Anyhow, back at the beginning of the year, this 253-day moving average of the equity only put call ratio. Remember I showed you that huge cluster for a year and a half of very low put call readings? Well, this is the 253-day moving average. And I think you can see what was happening during the 2 years that the market kept going straight up. Look at how sentiment turned so crazy bullish. Well, we were just starting to make this turn to the upside. So we were just beginning to go through what I believed was going to be a reset of sentiment. And I showed this chart again down below, and look at where we are now. So look at all the bearishness picking up now after the market has declined 18%. And by the way, normally for bearish sentiment to really start to pick up coming off of this kind of a low, it's going to be really hard for the market not to go down. If the market didn't go down, sentiment wouldn't change. The only way you can get a reset of sentiment back to the upside is for the market to scare the heck out of people. Welcome to 2022. All right. Last thing I wanted to go over, I just wanted to show you why, you know, when we look at the S&P 500 right here, let's go back to that daily chart. So we've really picked up here in the last 7 weeks or so to the downside in the S&P 500. And what I was talking about earlier in the year was once we started to lose support from the big boys, and I'm talking about Apple, Microsoft, Google, Amazon, Facebook, Tesla, those names. Once those groups or once those stocks started to perform more poorly, especially Apple was helping to hold the market up. Do you know Apple is more than 11% of the QQQ? More than 11%. That's a lot. That's a big percentage of a major ETF like that. You got 100 stocks in there. So the average stock's going to represent 1%. Apple's 11%. So it makes sense that when Apple struggles, here's the beginning of April. Look at where we've gone on Apple relative to the S&P 500. That's what this chart is. It's a relative chart. So if Apple is 6% of the S&P 500 and 11% of the NASDAQ, and it begins to underperform, it's going to magnify the S&P 500 to drop. And when you look at Apple and some of the other heavily weighted stocks, here's Microsoft. Here was April. Here's where it is now. Here's Google. April. Here's where it is now relative to the S&P. Amazon. Here's the beginning of April. Here's where we just went to. Facebook. Now, Facebook is down a little bit from April. It already took its tumble earlier. But those are the 5 big names in the S&P 500, and they all are underperforming the S&P 500 since April 1st, most of them by a very wide margin. That's why the S&P is falling apart. It's those 5 names. I mean, it's the whole market. Growth stocks are getting hit. But once that large cap growth started to underperform, the market had no defense. S&P had no defense. So we've got to let these 5 stocks, before the overall market can really start to pick up, we got to let these 5 stocks find their bottoms. I mean, it's that simple. Apple just broke down. So let me give you this chart. This will be one of the 3 you must see. Apple broke down below 150. And by the way, I wrote an article back at the beginning of the year. You can go check it out. I made a wild prediction about Apple when it was 180. I said it was going to 140. Got some hate mail for that one. You know, Apple is the best stock out there. basically you're crazy. 140. Well, there it was, 140. Apple's not immune. It was for a while. I mean, it was almost 180 at the end of March. This is when things fell apart. When did the stock market fall apart? When Apple could no longer hold on. That was when it fell apart. And I think this is all recession related. Apple has pricing power. I think the big thing with inflation, when we were worried about inflation, Apple held up because they have pricing power. Who's going to stop going to Apple because they raised their prices? Nobody. But recession hits everyone because simply fewer products are purchased. So Apple and all the others getting hit since April. All right, so that was one. Let me give you a couple of others here. By the way, there's not really much in the way of earnings coming out today. I think Take-Two Interactive, an internet company, will be reporting after the close today, but nothing really big. We've gotten through the really big reports. We'll have some later this week. I think Cisco reports. Applied Materials reports. That's a big one in the semi-equipment area. I think they report on Thursday. All right. Where are the others? Oh, wanted to look at Nike. So there's Nike getting hit pretty hard to the downside, still in a downtrend. Sometimes when I see the dailies in a downtrend, I'll look at the weeklies to see maybe if we're starting to see any positive divergences or any major support levels approaching. I mean, this is in the last 5 years. This is the worst the weekly PPO has been on Nike in the last 5 years. We can go back 10 years. Let's see how bad it was. It's the worst in the last 10 years. I mean, this is a big sell-off for Nike. Now, at some point, we're probably going to print a positive divergence. Maybe what we do is we bounce temporarily and then come back down and set a positive divergence closer to 100. I don't know. Maybe that would be the way a bottom would form. I'd certainly keep an eye out for that. And then the last chart I'll show you is CRM, Salesforce.com, which has also been under a lot of pressure. PPO here, -10, also the lowest we've seen in the last 10 years. So this is the deepest, what I would say is the deepest sell-off and probably the scariest sell-off that we've had since the 2009 low. I think 2015, 2016, if you looked at the S&P 500, it lasted longer. Right here, we topped in the middle of 2015. This went on probably for about 9 months. Had a false breakdown. We actually moved to about a, I don't know, what is that, a 16-month low right here before moving up. So I think we could still have a little bit of downside. I still think 3,500 is possible on the S&P. But if we get to 3,500, I will probably have my position unless, I mean, I'm going to continue to follow signals, but unless I feel like something major has changed, I'm going to be building a position down to 3,500, and I will probably be 100% full in my, I'm talking about the retirement where I'm adding money into the QQQ and the SPY. Listen, if I'm out when the S&P 500 is at 4,800 and I can get back in the 3,000s, knowing what I know about the stock market, I'll do that anytime. Anytime you want to just let me get out the high and let me back in 20% lower, I'll do it. And trust me, that'll bode really well over your lifetime if you're able to catch these moves to the downside like this. All right, that is it for me. I appreciate everybody tuning in. I'll be back tomorrow at 9:30 over at Stock Charts TV for your next episode of Trading Places Live, or at 9 o'clock, I should say. So at 9 o'clock tomorrow morning, just click on that link and tune in, and we'll go over the latest. Everybody have a great rest of your day, and be back tomorrow. Also, don't forget, spring special starting today. Love to have you extend your membership, or if you're new to Earnings Beats, come on in, check us out, and then take advantage of our best deal. Have a great day, everybody. Happy trading.